Drones are all the rage these days. Whether they're used as toys, tools, or weapons, investors are throwing money at them like there's no tomorrow. Today we're going to talk about 5 hot drone stocks. And just because they're hot doesn't mean you should be investing in them, despite what all the instant analysts are saying. So you're probably wondering which 5 drone stocks we're going to talk about today, you and your 7-second attention span. Okay, fine, here are 4 of them. First, you have Red Cat. You see here I asked Super Grok to tell me which drone stocks are having the most discussions amongst retail investors. They talk about significant retail buzz due to a U.S. Army contract for Black Widow drones and a Palantir collaboration. We're going to talk about that. Then there's Draganfly. They're a small cap stock with high volatility. That means a lot of risk gaining attention. They also mention Unusual Machines and another firm called Xenatech. And in our recent piece on ARK's 6 drone stocks, many comments on that video talked about these various names as well. But Joe, you said you're going to talk about 5 stocks, not 4. Yes, Rain Man, I did. You'll just need to keep watching to learn about the 5th and perhaps the best stock that we're going to talk about today. So the first thing you'll need to do is change your mindset. So there's over 4,000 stocks to choose from in the USA. So Joe, retail investor, can manage a portfolio of about 30. But he doesn't, though. It's usually a lot fewer than that. Now, almost every retail investor starts by looking for that one special stock that's going to allow them to change zip codes. And financial pundits, they know that darn well. Do not allow yourself to be pulled in 420 different directions. Stop looking for the best story. All that's going to do is allow yourself to be swayed by glorified salespeople. Start looking for reasons to not invest in any given company. Why? Well, check out this Bessembinder study. I absolutely love this piece of work. He considered 29,000 publicly traded companies that had traded for some period of time over the past 98 years. Of these, over half had negative cumulative returns. Start by trying to avoid these. Pundits don't do that because it doesn't generate clicks and clout. For example, take a look at these comments on Red Cat stock. So here at Forbes, our cat stock to $25. Pundits and analysts alike often pull price targets out of their asses. You see this piece by MarketBeat. Stocks ready to soar. That's a popular, very lazy FinTwat term to use. You see this other piece here a day ago. Tremendous return rates. I never studied anything about tremendous return rates. But here you see a piece talking about Red Cat being an exceptional stock. Now we can start looking at that. What is an exceptional stock? Well, first of all, you need to consider the types of stocks we're analyzing, whether they're growth or value. In this case, it's growth. So we're going to look at revenue growth being a proxy for market share being captured. Then we're going to look at gross margin, not operating margin. We would expect most growth firms to not be profitable yet. Gross margin simply tells us the potential for them to eventually achieve profitability. And of course, we like to look at valuation, which shows us whether or not a stock is being hyped. Drones, AI stocks, quantum computing companies, these are all themes that have been getting a lot of hype lately. So what about Red Cat? Well, when we take a look at their revenues, remember I talked about revenue growth. We indeed see some recent revenue growth in 2024. They have $18 million in annual revenues. That clears our cutoff of at least $10 million for revenues to be meaningful. However, when we break this down on a quarterly basis, we see something interesting here. We see a spike that contributed a lot to that $18 million number, and this irregularity is something that we'd want to investigate. Well, in the process of doing so, we came across this statement that the company is expecting guidance for this coming year of between $80 million and $120 million. That's a huge jump. Now we understand why the stock is seeing so much attention. So if we calculate our simple valuation ratio based on today's numbers, comes in at 67. Now you can see that if we calculated that same number using the midpoint of their guidance, then we get the number 11. So that's a lot more reasonable. It's still somewhat rich, but it's now understandable why the company is valued as it is. That guidance is already priced in. Now, investing in stories rarely seems to pan out in the real world, but the real showstopper here for us would be the potential for profitability. You see this gross margin in a particular quarter of 19%. We'd like to see some consistency around that. We'd like to see it higher than 19%. So granted, all the defense primes out there have very low gross margins. They're also operating in a completely different world in terms of the size and economies of scale they can leverage. So things to watch for Red Cat, their annual revenue guidance, you'll want to see them hit that. And of course, you have these sub-segments that you can watch to see where they excel in terms of the guidance they've given or where perhaps they miss. In terms of that partnership with Palantir, that's about as meaningful these days as a partnership with NVIDIA. It means very little. Pay attention to hard numbers, not flowery press releases. So let's see if they hit those numbers and at what gross margins, and then we'll take another look. Now, for us, a lot of these companies trigger a showstopper, which means we don't go any further. Remember, there's so many stocks out there to analyze. We try to eliminate as many stocks as possible using tried and true rules. One being that we have a market cap cutoff of $1 billion. So this is a basic rule most institutional investors follow for a reason. It's because these micro and nano caps don't outperform. And there's a lot of landmines. So all 4 remaining companies on our list actually fail this screening criteria. However, you may choose to continue. Now, when you do continue, you'll quickly hit showstopper number 2. So we expect companies to have meaningful revenues because execution is everything. This is perhaps the most effective rule we have for taking out the trash. We define meaningful revenues as $10 million per annum. We do not continue below this number. However, you may choose to continue. But when we look at these companies, remember, you're always investing in companies, not stocks. So you see Unusual Machines here, up 600% in a year. This isn't intrinsic value suddenly being created. It's hype. And you can see when Trump Jr. joined their board, so that happened in November of 2024, and the price of the stock reacted accordingly. That's only as good as the current administration. When we look at their revenue growth, we see, all right, they're actually having a positive gross profit. Well, that's a good sign. And we see that they're getting there in terms of hitting that meaningful revenue number. Now, when we consider the hype around that stock, I think recently that's been attributed to this piece here in the Wall Street Journal. It says the drone stocks fly after Pentagon lifts curbs. Be very careful of stocks that move together on a single piece of news. This is often going to be exacerbated by alpha chasers on social media who think they've uncovered some big secret. This is a fund it and they will come story, which may last only as long as the current administration. So all the companies we're talking about today, they're all classified as aerospace and defense stocks. So you need to ask yourself, would major defense contractors provide better exposure here for a long-term investor? Probably the case. Now, for those of you that still decide to continue, you want to be very careful about dabbling in hyped stocks. So only 2 of these firms have a valuation below our cutoff. Remember earlier we gave you the example of our simple valuation ratio calculated for Red Cat? Well, here we've calculated it for all these names, and you can see that only 2 are below our cutoff. One looks attractive and one doesn't. So Draganfly, when you go through their investor deck and see what they have to say for themselves, they want to talk about their 25 patents or all their milestones. We don't care about any of that. When patents are a given that you're doing R&D, right? We want to see meaningful revenue growth. Here we see no revenue growth from 2023 to 2024. And when they actually do have growth, we want to see consistency, not spikes. And then there's Aero Group Holdings. They had a recent IPO that was brought to our attention, of course, by a subscriber. And this is a drone stock worth checking out. So can you see the difference here? First of all, it has a reasonable valuation at the moment. I'm surprised it's not being hyped. It must be flying under the radar, right? But you can see this beautiful revenue growth over time, consistent, sustained. Look at gross profit. It's actually increased so where they're able to cover operating expenses and generate a positive operating income. This is a company worth digging into a little deeper, but when you go to their website, you look for a simple investor deck to see what the thesis looks like. It appears they don't care much for investor relations, so then we can go to the S1 filing. We see here that 86% of their revenues come from drones. That's great, right? That's the exposure that we want to see. But you need to be very careful here. Out of the 4 segments they have, one of these is pre-revenue. It's an electric air mobility. So the eVTOL thesis is very risky, even if you're investing in the so-called leaders today, Joby and Archer. So we wouldn't find that appealing about investing in this firm. And they were actually formed quite recently in 2021. They say here, for the purpose of acquiring and integrating various companies engaged in the aerospace and defense industry. So you have to ask, well, are there synergies here? You know, this is the sort of rolling up that we see in the space sector, right? Firms going public via SPAC and going out and buying a bunch of other companies. Very difficult to realize synergies. This stuff oftentimes doesn't work out very well. And when you look at what they've acquired, they divide it into 3 sections here, and then you can start to consider goodwill, which is essentially, one might argue, what they overpaid for the firms that they purchased. And you see they're already writing down impairment charges for the electric air mobility segment and training segment. That's not a good sign, right? And they say here, we derive a significant portion of our total sales from the U.S. government and its agencies, so that's a risk factor. However, when you look at the reasoning for recent revenue growth, they say, well, increased drone sales were driven by market entry strategies to target NATO member countries. Okay, so maybe they're diversifying away from that heavy dependency on the U.S. government. That's great. Now, just remember, there's really 2 camps of investors here. I would say most people fall into one of these 2. You have the long-term investing mindset. This is the sort of person that understands intuitively why setting a stop loss after you open a position is about the dumbest thing you can do as a long-term investor. If a stock price falls after you purchase some, you buy more. You don't go and sell it. These are people that look to invest in leaders with solid balance sheets. So they pretend like the market's going to close for a decade after they open their position, so they're as concerned with survivability as they are with growth. There's a lot of growth stories out there that fail. Then you have the short-term mindset. These are most of the FinTwats that you see out there that treat the market like a casino. They assign credibility to analyst stock price targets. They dabble in astrology for men. Just remember, it's very difficult to play both sides here. So some people try to take advantage of the hype that you see and play musical chairs. Don't try to do that with hype stocks because A, you're going to lose doing that over the long term. You may have some short-term wins that you'll brag about on social media, but long term, you're going to lose. Even professional money managers can't beat the market over the long term. Let's say a very small percentage of them. Be an investor, not a speculator. So for those of you interested in drone stocks, I'm going to leave you with another video we did on 6 drone stocks that ARK's holding. It's rather interesting. You ought to give that a watch next. Thanks so much for taking the time to watch this today.